Welcome to the Deep Dive. Today, we're embarking on a mission, really, to empower you with smarter financial choices. We've gathered a wealth of sources, from seasoned personal finance consultants to visionary investment gurus, all to extract those truly potent nuggets of wisdom for your financial journey.
That's right. Our goal is, well, it's to cut through the noise. We'll identify common money mistakes that can cost you dearly, then shift gears to explore the world of investing.
Right.
From the foundational principles, building a robust portfolio, to the fascinating art of finding hidden value in the market.
So this is kind of like your shortcut.
Exactly. Consider this your shortcut to being genuinely well-informed in your financial life.
Okay, let's unpack this then. Our sources reveal that while the list of financial missteps seems, well, almost endless, certain bad habits or decisions driven by wishful thinking can really chip away at your wealth over time.
Oh, absolutely.
These aren't just minor errors, they're significant pitfalls.
Exactly. It's about understanding the long-term impact of seemingly small choices and preparing for the unexpected. Take your paycheck, for instance. Barbara Friedberg, she is a personal finance consultant, strongly advises against cashing it right away. If that money hits your hands directly, you're far more likely to, well, burn through it too quickly, spend it all.
So the temptation is just too strong.
It really is. The true nugget here isn't just avoiding spending, but optimizing for growth.
Okay, so it's about making savings automatic, almost invisible, to prevent that immediate gratification.
Precisely. Friedberg suggests a smarter play. Automatically transfer a percentage directly into a retirement investment account, like a 401k perhaps, and then direct deposit the remainder into your checking. The power of a workplace plan is huge here because the money is deducted and invested before you even see it.
Right, out of sight, out of mind.
Out of sight, less likely to be spent. And to truly maximize every dollar, using a consistent budgeting template can really help you understand exactly where your money goes and, crucially, where it can be better allocated.
That's a powerful way to kind of trick yourself into saving, isn't it?
It really is.
Now, beyond daily habits, sometimes the biggest pitfalls are, well, they're disguised as opportunities, like those enticing special finance deals, the ones that sound too good to be true.
Oh, they often are. Grayson Bell of Debt Roundup, he learned this the hard way. Financed a $10,000 jet ski, no money down, lured by a super low $69 per month payment. Sounds great.
It's amazing, yeah.
But what he discovered, and what many people miss in the excitement, is that the low rate was only temporary, just for 2 years.
Wow.
After that, it changed to include retroactive interest based on the entire original loan amount.
Ouch. That's gotta hurt.
Big time. His crucial takeaway was simple. Always go through the math, understand the total cost, and read all the fine print. Those deals can financially devastate you if you're only focused on that low monthly payment.
And on the topic of debt, we've all heard stories about co-signing loans, often for friends or family. Seems generous, but risky.
Hugely risky. Michelle Schroeder-Bardner, she runs Making Sense of Sense, has a very firm stance. Never co-sign a loan for someone unless you genuinely have the means to pay back the entire amount yourself.
The whole thing.
The whole thing. Because you simply can't guarantee that the other person will make every single payment, and when they don't, guess who's on the hook?
You are.
That responsibility falls squarely on you. It's a major risk, not just to your finances, but potentially your relationships too.
That really underscores protecting yourself first. Now, on a broader scale, Kathy Curtis, she's a certified financial planner, often stresses a core tenet of building true wealth, consistently living below your means.
Essentially.
This isn't about deprivation, really. It's about intentionality.
It's absolutely crucial. Living below your means, making saving and investing genuine priorities, that provides the foundation for financial comfort. Whether it's, funding a child's education or enjoying a secure retirement, it's the opposite of lifestyle creep.
Right.
And speaking of security, Curtis also offers practical advice for travelers. Never rely only on cash.
Oh, interesting. Why is that?
Well, carrying substantial amounts of cash, especially in tourist areas, significantly increases your risk of theft or loss. Travelers' checks or credit cards offer far more security. Just a practical tip.
Makes sense. And what about those unsolicited calls asking for donations? That happens all the time.
Yeah, it does. Kathy Curtis strongly advises against donating money over the phone. Unfortunately, con artists frequently use these tactics.
Oh, just hang up.
Well, her recommendation is to ask for information to be mailed to you. that gives you time to actually research the organization thoroughly, verify its legitimacy before you even consider contributing. It's about due diligence, even when you're trying to be charitable.
Okay, that's smart. We often hear about retail therapy, but it sounds like it can be a pretty significant financial trap.
Oh, it most certainly can be. Kathy Curtis highlights the danger of shopping when you're emotional, stressed, sad, even overly excited.
Right, the highs and lows.
Exactly. Don't let pushy salespeople talk you into purchases you can't truly afford or, frankly, don't need. Your financial decisions should always be based on your actual needs and your budget, not some fleeting feeling or external pressure from a crazy sale.
Yeah, that 75% off sign is tempting.
But it doesn't make something valuable if you don't actually need or want it, like, a pile of bath bombs or beach towels in the middle of winter.
Good point. Shifting our focus now to longer-term wealth building, what's a critical mistake many people make with their workplace retirement plans? Like a 401k.
Yeah, Esther Kim at 4USOL, they're a low-cost 401k provider. She identifies opting out of your 401k as one of the biggest mistakes you can possibly make.
Just opting out completely.
Yes. Even if your company has automatic enrollment, you should actively choose to enroll. Then try to increase your contribution above whatever that auto-enrollment amount is, and definitely sign up for automatic escalation.
Automatic escalation. What's that exactly?
That's where your contribution percentage automatically increases slightly each year, maybe by 1%. The power of compounding interest, especially if there's an employer match.
The match is key.
It's huge. Missing out on that is literally leaving free money on the table.
Okay, that's a big one. And when you're ready to seek professional guidance, how do you avoid falling prey to a bad financial advisor or even, outright fraud?
That's a serious concern. Julie Rains, a personal finance writer, she emphasizes never investing your money with someone you don't trust implicitly. The risks include fraud, obviously, but also just excessive fees that eat away at your returns over time.
So how do you find someone trustworthy?
Seek recommendations from people you trust, friends, family. But then, crucially, do your own homework. Research their designations, check their background on official regulatory websites like the SEC or FINRA. You have to vet the person who's going to manage your money.
So due diligence on your advisor is just as important as on the investments themselves.
Absolutely.
What about asset allocation? Is putting all your eggs in one, say, illiquid basket a risk?
A huge risk. Daniel Zajac, another CFP, strongly advises against putting all your money into illiquid investments. You need to be keenly aware of when and how you can actually access your money.
Because life happens.
Exactly. Unlike highly liquid investments like, regular stocks, mutual funds, ETFs, illiquid investments, think non-traded REITs.
What are REITs again?
Real estate investment trusts. Companies owning or financing income-producing real estate. Some types aren't easily traded. Or certain collectibles. These things cannot be sold quickly without potentially taking a significant loss. Liquidity gives you flexibility and security.
It sounds like intentionality is just key across the board, isn't it? From budgeting all the way to investing.
Exactly. Financial coach Melissa Thomas recommends being highly intentional with your money, like actually labeling savings accounts for specific purposes. This is my emergency fund, this is for holidays, this is retirement.
Earmarking it.
Precisely. Keeping long-term goals separate from shorter-term ones helps maintain focus and prevents you from, dipping into funds meant for future growth. And on a fundamental level, never lose track of your money.
Don't stick your head in the sand.
Right. Turning a blind eye to expenses and income is a definite no-no. Always be aware of your spending, your income, your financial goals. A budget isn't just a suggestion, it's absolutely key here.
Okay. Moving to big purchases. It's a common, yet often overlooked financial misstep many people make when buying a house, besides just the sticker price.
Right. Josh Ledger of Savings Angel points this out well. Homeownership extends far beyond just the mortgage payment. Many people overlook or seriously underestimate additional costs like repairs, ongoing maintenance.
Oh yeah, the roof, the furnace.
Exactly. Fluctuating utility bills, potential property tax increases. Failing to factor these in can quickly lead to piling up unexpected debt. You need to budget for the total cost of ownership.
And what about signing any kind of agreement, not just for a house?
He strongly advises against signing any contract you don't fully understand. It's a critical point.
You're a lawyer.
If it's significant, yes. Always consider having an attorney review it. Signing something you don't grasp can commit you financially for a very long time and potentially at a very high cost. It's a common trap, especially with complex jargon.
This next pitfall can be particularly tricky, especially when it involves close relationships. Loaning money.
Yeah, Kirk Chisholm, he's a wealth manager, suggests thinking long and hard before loaning money to friends and family, especially if you have any doubts about their trustworthiness or their actual ability to repay.
Because it can get awkward.
It can get way beyond awkward. Not getting your money back can severely damage relationships. His pragmatic advice: if you decide to lend it, be okay with potentially saying goodbye to that money forever. Treat it almost like a gift in your mind.
That's a tough mindset, but probably realistic. Now, we all buy things we don't use, but it seems like those small, seemingly insignificant purchases can really add up and become a drain.
Oh, definitely. Josh Ledger highlights wasted money on items people neither need nor really use, like fancy phones they don't know how to operate fully, or extended warranties on products already covered by a manufacturer's warranty.
Guilty.
Or even just groceries that spoil because you forgot you had them. He suggests a simple exercise. Stick to buying items you'll use daily or very regularly. You'd be surprised how much money you can find in your budget just by eliminating these leaks.
Okay, let's wrap up this segment with some high-risk investment traps. What's the cardinal rule here? The absolute must remember.
Pauline Paquin, a finance blogger, emphasizes this above all else.
Yeah.
Never invest money you can't afford to lose. Period.
Not a penny.
Not if losing it would jeopardize your fundamental financial well-being. Every investment carries risk, and you should always be prepared for the worst-case scenario. Don't bet the farm on speculative ventures.
Okay.
And along those lines, Joseph Carbone, a CFP, warns that if an investment sounds too good to be true, well, you know the rest.
It probably is.
It almost certainly is. He has a great rule of thumb. If it sounds boring, it's probably a good investment. Those too good to be true schemes are often expensive, illiquid, whereas staple investments like, broad market stocks, bonds, maybe CDs, might perform far better over the long haul.
And the lottery. Everyone lives the dream and a quick win.
While the dream is appealing, the odds are just astronomical. For a Powerball jackpot, we're talking about 1 in 292 million.
Wow.
Consistently spending even small amounts on lottery tickets significantly dents your financial success over time. It's far, far better to allocate that money to legitimate savings or retirement accounts where it has a real chance to actually grow.
Makes sense, even if it's less exciting.
And similarly, Sean Cooper, another financial expert, says deals websites like Groupon can be incredibly addictive. They can lead to overspending on stuff you just don't need.
The impulse buy.
Exactly. He advises a disciplined approach. Only visit those sites for items you were already planning to buy anyway. Don't let the deal create the need.
Finally, what's one of the biggest, most common money sinks for many people? A really frequent one.
Josh Ledger is clear. Never buy a new car if you can possibly help it.
Really? Never.
Well, if you can help it. That fleeting new car smell is incredibly expensive when you factor in depreciation. He strongly advocates for buying pre-owned instead. He argues that a constant new car payment significantly hinders financial freedom.
Because it just eats into your budget every month.
Every single month. The key is to always assess if you can truly afford a large purchase, factoring in not just the payment, but depreciation, insurance, opportunity costs, and prioritize used options when they make financial sense.
Okay, so we've covered a lot on how to navigate the money minefield, avoid those pitfalls. But beyond just playing defense, how do we actively put our money to work and actually build towards our financial goals?
Right. This is where we shift from defense to offense. Investing is how your money can potentially grow faster than it would just sitting in a standard savings account, which is especially crucial when you consider that cash actually loses value over time due to inflation.
Inflation, the silent killer.
Exactly. So the first step is to clearly define your investment strategy. Like, actually list your reasons for investing. Is it for retirement, a down payment on a house, maybe even just owning a piece of your favorite company?
So getting crystal clear on the why before you even think about the how, and setting specific, measurable goals, I assume.
Exactly. Identify specific investment goals. Like, I want to aim for $1 million for retirement, or maybe $50,000 for a child's college fund. Use investments for these large, long-term goals.
And for shorter-term stuff.
Yeah. For smaller, shorter-term goals, like needing, say, $10,000 for a car in 2 years, a high-yield savings account is generally a better, safer option. The stock market is too volatile for short timelines like that.
Got it.
Next, you need to calculate your time horizon. This is simply how long you plan to keep that money invested. So for a child's college education, if they're 4 years old now, you have about 14 years until they start college.
Okay, so for a relatively shorter horizon, like 14 years, you choose lower risk investments. Is that right?
Generally, yes. Compared to someone younger, if you're, say, 25 and investing for retirement at 65, you have a 40-year time horizon. That longer runway gives you more leeway to take on potentially riskier investments, like more stocks, because you have ample time to recover from any market downturns along the way.
Makes sense. Time smooths out the bumps.
It can help. And while returns are never guaranteed, of course, understanding average historical returns can help you estimate roughly how long it might take to reach your goals with a certain investment mix.
Okay, so you know your goal, you know your timeline. What's next?
Set an investment budget. This means really understanding your current financial situation. Create a household budget, income versus expenses, see what's left over.
And once you have that clear picture, you can figure out how much you can realistically allocate to savings and investments each month or year.
Exactly. And your budget also helps determine the kind of rate of return you might need to reach your goal. For example, if you consistently invest $500 a month for 40 years, that's $240,000 you've put in. To reach a significant goal like $1 million, you'd need an average rate of return of at least 6% over that whole period.
So the numbers start to become real.
They do. And a crucial tip for newcomers, practice before you play. Seriously. Use a stock market simulator.
With fake money.
With fake money. Hone your strategy, learn how the investment platform works, get comfortable. Many online brokers offer this feature now. It's a great way to learn without risking real cash.
Okay, that's really practical. So once you're ready to actually invest real money, how do you start building a diversified portfolio, especially if you're new to this whole thing?
Right. First, you'll need to open an investment account with a brokerage firm. You typically need a broker to buy stocks, bonds, funds, etc. It's smart to compare different online brokers, look closely at their trading fees, any account maintenance fees, the tools they offer.
Do you research there too?
Absolutely. Then a great way to ease in is to maybe start with companies you're already familiar with. If you love Apple products, maybe your first investment is in Apple stock. It can keep you engaged, make the initial research feel less daunting than diving into some obscure industry you know nothing about.
So ease into it with what you know.
Yeah.
What about broader, maybe more conservative options for long-term growth, not just individual stocks?
Yeah, for more conservative long-term growth, mutual funds are an excellent choice, especially index funds.
Index funds, you hear about those a lot.
Right. These funds hold tiny pieces of all the stocks in a particular market index, like the S&P 500, so you get really broad market exposure automatically. Very diversified. Exchange-traded funds, or ETFs, are similar in many ways. They can invest in baskets of various assets too, maybe real estate, commodities, specific industries, bonds.
Okay, so funds offer instant diversification. What about balancing the portfolio? You hear about stocks and bonds.
Exactly. To balance your portfolio further and potentially reduce overall volatility, you'll likely want to add bonds. Bonds are generally less volatile than stocks and can provide a steady income stream through interest payments.
And commodities. I often hear about gold or oil as investments, especially when things get shaky.
Yeah, commodities like coffee, corn, crude oil, or precious metals like gold can sometimes act as a hedge against risk in other parts of your portfolio. Their value might increase when stocks are experiencing a downturn. Gold, for example, often goes up during stock market volatility as investors seek a perceived safe haven.
But proceed with caution there, too.
Definitely. And be aware that certain types of bonds, like high-yield bonds, often called junk bonds, because of their lower credit rating, carry significantly higher risk, though they offer potentially higher returns. It's all about risk tolerance.
Got it.
And finally, a really important point. Don't invest everything all at once. Grow your portfolio gradually. Contribute a little bit regularly, maybe each month or each quarter over several years.
Dollar cost averaging.
That's the strategy. It's called dollar cost averaging. It helps you avoid trying to time the market, which is almost impossible, and allows you to potentially buy more shares when prices dip and fewer when they're high, averaging out your cost over time.
Okay, this is where, for me, it's really interesting. What if the entire market isn't always efficient? What if it's not always right about a company's true worth? How can you possibly spot those hidden gems that maybe everyone else is overlooking?
Now you're talking about the fascinating concept of value investing, famously articulated by Benjamin Graham and, of course, championed by his student Warren Buffett.
The Oracle of Omaha.
Indeed. It's all about recognizing that Mr. Market, as Graham colorfully called him, can be, well, quite irrational at times.
Mr. Market. Explain that.
Graham imagined the market as this manic, depressive business partner. Some days he's euphoric and wants to sell you his share of the business for a crazy high price. Other days he's despondent and offers it to you for pennies on the dollar. The point is, his mood, his price, often has little to do with the underlying reality of the business.
So the market price isn't always the true value.
Rarely, according to value investors. One core reason stocks can be undervalued is simply the market's poor judgment. It often fails to see or appreciate attributes that genuinely make companies money. Think about the e-commerce potential that, say, Jeff Bezos recognized early on for Amazon when others didn't.
So it's not just about what a company is now, but what the market perceives it to be or what it could be. And those don't always line up.
Precisely. Another factor. Many investors simply don't truly understand the underlying businesses of the companies they're trading. They're just trading ticker symbols. This ties into what the investor philosopher Nassim Nicholas Taleb calls the green lumber fallacy.
Green lumber fallacy.
Yeah, it's the mistaken belief that a successful trader in something, like green lumber, must be an expert in the properties of green lumber itself. Taleb found the most successful trader didn't even know green lumber meant freshly cut, not lumber painted green. His success came from understanding market patterns, not the product. It shows a disconnect.
Fascinating. So people trade without fully understanding.
Often. And another major factor causing undervaluation is short-term thinking. Most market participants are focused on the next quarter's earnings, the next news cycle. They fail to grasp a company's long-term potential or resilience.
Which brings us back to Graham's Mr. Market analogy, that irrational salesman.
He is. Graham literally described the market as an insane salesman who one day might offer you a Ferrari for $100 and the next a broken Chevy for $10,000. The market rarely prices companies accurately based on intrinsic value, especially in the short term.
And Buffett built his career on this idea.
Absolutely. Value investors like Buffett actively look for companies hit by bad news, because the media and the market's reaction can often exaggerate the true long-term effect on the company's underlying business fundamentals.
That's such a counterintuitive approach, like that American Express story. I remember hearing about that.
Exactly. Back in 1963, American Express stock plummeted because of a scandal involving faulty warehouse receipts for salad oil from a subsidiary. Total mess.
Salad oil? Seriously?
Salad oil. But Buffett looked past the headlines. He saw that the core credit card business, the part that really mattered, was fundamentally sound and completely unaffected by this weird scandal. So while everyone else was panicking, he bought more stock, made an absolute fortune when investors eventually forgot the scandal and the true value reemerged.
Incredible. Just seeing through the noise.
That's the essence of it. He also famously seeks out unpopular stocks. The stock market is often a popularity contest, right? Driven by hype. Buffett looks for valuable companies that Mr. Market just doesn't like, companies that aren't sexy or fashionable, but still consistently make money. Think about Walmart.
Right. Walmart may be overlooked by some wealthier investors chasing tech, but it remains the world's largest retailer with massive, massive revenue.
Exactly. It really emphasizes spending more time digging through dull financial reports than getting caught up in the excitement of financial media.
Okay, so how do you actually go about identifying these potentially undervalued stocks? Where do you start?
Well, a general approach is to look for strong brands, profitable companies whose stock happens to fall significantly, say 10% or more, especially if technical analysis shows good support and resistance charts, suggesting the race might be bottoming out.
Could you explain support and resistance charts just briefly? It sounds a bit technical.
Yeah, sure. In very simple terms, support is a price level where a falling stock tends to stop falling, almost like it hits a floor because buyers step in. Resistance is the opposite level, where a rising stock tends to stop rising like it hits a ceiling because sellers take profits. It's part of technical analysis that some investors use to gauge market sentiment.
Okay.
You can also use brokerage screeners. Most online brokers have tools where you can filter stocks based on certain criteria. For example, you could input a price to earnings or PE ratio lower than, say, 15 to find companies that might be relatively cheap compared to their earnings.
The PE ratio, that's a common one. But a low PE doesn't automatically mean it's a good buy, right?
Yeah, absolutely not. It's just a starting point. You need to understand why the PE is low. But beyond PE, what are some of the key financial indicators that serious value investors really scrutinize to determine if a stock is a hidden gem?
Yeah, what are they digging for in those reports?
Okay, one foundational concept is book value. This is basically an appraisal of all a company's assets. It's real estate, equipment, inventory, intellectual property like patents or brands, and it's cash. Think of Disney's book value. It includes its theme park land, its studios, its vast film library, even the value of Mickey Mouse himself.
Okay, so what the company physically and intangibly owns.
Right. Then there's a related concept, tangible book value. This focuses specifically on the physical assets in cash, deliberately excluding those intangible assets like brand reputation or patents, because those could be harder to put a concrete, reliable price on, especially in a liquidation scenario.
So tangible book value is more like the hard assets value.
Exactly, more conservative. Another crucial metric is enterprise value, or EV. This represents the theoretical takeover price, the total value of the company, including its market capitalization, stock price times shares outstanding, but also factoring in its debt and subtracting its cash. Believe it or not, a negative enterprise value can sometimes pop up, potentially signaling deep undervaluation, particularly in distressed situations.
Negative value, how does that work?
It usually means the company has more cash than its market cap plus its debt combined. It's rare, but it happens. Then there's franchise value. This is that intangible but very real worth of a company's name, its reputation, its customer loyalty. Think of Apple again. Its reputation for quality allows it to command premium prices and maintain fiercely loyal customers. That's a massive asset, even if it's not on the balance sheet in the same way a factory is.
And dividends, you mentioned those earlier. Many investors focus heavily on those steady payouts.
Indeed. Dividend yield is a key metric for many value investors. It's the annualized payout from a company's share price, showing how much income investors can expect relative to the stock price. Many dividend investors prioritize companies with a history of steady, preferably growing high dividends. Apple, for instance, while also a growth story, is considered a solid dividend stock.
Okay. And Benjamin Graham, the father of value investing, he had his own special metric, right?
Yeah, he did. A classic Graham tool is net current asset value per share, often abbreviated as NCAV or NSAPX. This is calculated simply by taking a company's current assets, things like cash, accounts receivable, inventory, and subtracting all of its liabilities, both short-term and long-term.
So current assets minus total liabilities. Why was NCAV so important to Graham? What did it tell him?
Graham looked for companies where this NCAV per share was significantly higher than the actual stock price per share. He called these net nets. Essentially, it was like buying $1 for 50 cents or even less. It meant that if the company were to theoretically liquidate all its easily sellable assets today and pay off every single one of its debts, the cash left over would still be more than what the entire company was selling for on the stock market.
Wow. That sounds like a huge margin of safety.
That was exactly his term, margin of safety. It provided a buffer against errors in judgment or just bad luck. Beyond these specific metrics, value investors also generally look for signs of a healthy business. Solid revenue growth, a reasonable cost of revenue, positive operating income, positive net income, and especially high free cash flow.
Free cash flow.
Yeah.
That's the actual cash the business generates after everything.
Right. Cash left over after all operating expenses and capital expenditures. Many investors consider it a more reliable measure of profitability than reported net income, which can be influenced by accounting rules. They also look for strong cash reserves and sufficient short-term investments that can be quickly sold if needed liquidity again.
Okay, so it sounds like there's a lot to look for. But are undervalued stocks always a good idea? Or are there limitations and risks we need to consider?
Oh, definitely risks. Let's start with the advantages. They are often cheaper, obviously, which means you can buy more shares for the same amount of money. They can sometimes have less exposure to wild market fluctuations compared to high-flying growth stocks, and they may possess those unappreciated attributes we talked about: strong dividends, high cash flow, stability, or maybe significant overlooked growth potential.
But there are always downsides, even with a seemingly good value find, right? What are the catches?
Absolutely. The limitations are real. Often, these stocks have a low share price for a reason, maybe limited growth prospects, which could lead to smaller returns when you eventually sell compared to a faster-growing company. More seriously, undervalued companies can also be vulnerable. They might be in declining industries or susceptible to disruption from new technologies or more aggressive competitors. Think of how a traditional retailer like Macy's, despite its real estate assets, a book value component, struggled mightily against Amazon's fundamentally different asset-light business model.
So the value could be a trap if the business itself is fundamentally flawed or declining.
Precisely. It could be a value trap. So while hunting for undervalued stocks can be a powerful way to potentially maximize investments, like any stock, they carry inherent risks that require very careful analysis and ongoing monitoring. It's not a guaranteed win.
Okay, so we've armed ourselves with theory, avoiding pitfalls, basic investing, even the art of value investing. Now, what are some of the actual tools and approaches out there to put this into practice? How do you get started or maybe explore some more advanced investment types?
Right, let's get practical. We'll first look at how surprisingly straightforward it can be these days to get started with a simple online brokerage account. And then, for those maybe interested in higher risk, higher reward scenarios, we'll delve into something called special purpose acquisition companies, or SPACs.
Okay, online brokers first. There are tons of them now. Let's use Robinhood as a common example since many people know that name. How easy is it really for a beginner to set up an account and start trading with something like that?
It's generally designed to be incredibly user-friendly, almost like using any other app on your phone. To set up an account, you download the app. You might even get an invitation through a referral link. Sometimes they offer a free share of stock just to get you started.
Oh, yeah, I've seen those.
Right. You'll enter basic personal info, name, address, social security number for tax purposes, usually your online banking login to link your bank account. You typically must be 18 or older. Then you just fund your account by transferring money from your linked bank.
And trading itself, buying a stock.
Also designed to be simple. You usually use a search icon to find a company by its ticker symbol or just its name. Select it. You'll see some basic stats, maybe a chart. Then you just click or tap buy, enter the number of shares or dollar amount, and swipe up or confirm to place your order. It's often very quick.
And they usually have watch lists too, right? To track stocks you're interested in.
Exactly. You can add companies you're interested in but maybe not ready to buy yet to a watch list. That lets you easily monitor their performance over time.
Okay, that sounds incredibly straightforward almost. Frictionless. Maybe too easy for some.
That's a debate. The ease of access is great, but it also removes some barriers that might have previously encouraged more thought before investing. But the accessibility itself is remarkable.
Okay, now let's talk about SPACs. These have been making a lot of noise, generating a lot of buzz, particularly over the last few years. What exactly is a SPAC? It sounds kind of mysterious.
Yeah, the name doesn't help much. A SPAC is essentially a blank check company. That's the key nickname. It's a company that goes public through an IPO, but it has no actual business operations or assets other than cash raised from investors.
So it's just a shell company full of cash.
Pretty much. Its sole purpose is to use that cash to acquire or merge with an existing privately held company, thereby taking that private company public without it having to go through the traditional, often lengthy and expensive initial public offering or IPO process itself.
So it's like a shortcut to becoming a publicly traded company for the target business.
Yeah. Exactly. It's often presented as a quicker, potentially cheaper alternative to a traditional IPO.
And how do they actually work? What's the mechanism behind raising the money and finding a target?
Typically, a group of sponsors, these are usually experienced investors, maybe former executives with deep industry expertise. They raise the funds from other investors through the SPAC's own IPO. Crucially, at the time of the SPAC's IPO, they often don't have a specific target company identified.
They don't know who they're buying yet.
Not always specified upfront. Doing so allows them to avoid some of the extensive Securities and Exchange Commission (SEC) disclosure requirements that would apply if a target was named. So early investors in the SPAC are essentially betting on the sponsor's reputation, their track record, their ability to find a good private company to merge with.
So you're trusting the management team's skill. What happens to the money raised?
The funds raised are generally placed in a trust or escrow account. They sit there, usually earning some interest, until a target company for acquisition is found and announced. Once a deal is proposed, the SPAC investors typically get to vote on it. And importantly, if they don't like the proposed deal, they usually have the option to redeem their shares and get their initial investment back, plus any interest earned.
Okay, so there's an exit if you don't like the company they pick.
Generally, yes. It's worth noting SPACs have become much more regulated since the 1980s. Back then, they were known simply as blank check companies, and unfortunately had a bit of a shady reputation, sometimes associated with fraud. The structure is more robust now.
So what are the advantages that have made them so popular recently? They've attracted big names, billions in capital. Why the surge?
Several factors. One, they can be quite affordable for initial investors. Many SPACs IPO at around $10 per unit, usually a share plus a fraction of a warrant. And they often don't experience those huge price jumps on the first day of trading that you sometimes see with really hot traditional IPOs.
Making them more accessible.
Potentially, yes. Also, the newer breed of SPACs has often targeted companies in really sexy, high-growth sectors. Think electric vehicles, space tech, fintech, online gambling, health tech. Companies like Open Door, Clover Health, Nikola, Virgin Galactic all went public via SPACs.
So they tap into exciting trends.
They do. And while large institutional investors often get the first crack at SPAC IPOs, the sheer number of shares often sold can sometimes make it easier for individual investors to get a piece of the action compared to traditional IPOs, where allocations can be tight. Plus, for the company going public, the SPAC route offers potential advantages like a more streamlined disclosure process, potentially faster execution, and maybe more certainty on valuation compared to the traditional IPO roadshow.
But with high potential reward often comes high risk, right? It sounds like there must be notable disadvantages for investors looking at SPACs.
Oh, absolutely. The biggest one is the blind pool aspect we mentioned. Investors usually don't know the specific target company when they first invest in the SPAC itself. That makes traditional fundamental analysis impossible at the outset. You're betting on the sponsors.
Right, the blind bet. What else?
There's also lag time or opportunity cost. Your money can sit in that trust account, potentially earning very little for up to 2 years while the SPAC sponsors hunt for a suitable acquisition target. If they don't find one within the specified time frame, usually 18-24 months, the SPAC liquidates and your initial investment is returned. But your capital has been tied up and potentially missed out on other investment opportunities during that time.
And the track record. Do they actually perform well after the merger happens?
Yeah. It's definitely mixed. There was a Goldman Sachs report back in July 2020 that looked at SPAC performance. It found that, on average, SPACs tended to outperform the S&P 500 in the very short term, the first 1 and 3 months after the merger or acquisition announcement. But they tended to underperform the market over the longer periods of 3, 6, and 12 months after the merger was completed.
So initial hype, then maybe reality sets in.
That's one interpretation. However, it's not all bad news. Some SPACs do perform exceptionally well post-merger. The report cited Virgin Galactic Holdings, which appreciated something like 146% in the year after it went public via a SPAC merger. So it varies wildly.
Despite those risks and the mixed track record, their popularity clearly surged, didn't it?
Massively, especially in 2020 and early 2021. In 2020 alone, SPACs collectively raised an astounding $49.1 billion through IPOs. That was way up from $13.6 billion in 2019. This surge attracted huge names as sponsors or participants. People like Richard Branson, Bill Ackman, Michael Jordan, Shaquille O'Neal got involved. They also tend to fare relatively better during broader stock market declines, partly because they're holding cash and trust.
Okay, so if an individual investor is interested, despite the risks, how do you actually go about finding and investing in SPACs? It sounds like it's not quite as simple as just searching for SPAC on your brokerage app.
It's definitely not as straightforward as buying, say, Apple stock. Institutional investors usually get the first look and the largest allocations during the SPAC's own IPO. For individual investors, it takes a bit more effort. You can certainly ask your stockbroker or wealth manager if they have access to or insights on upcoming SPAC IPOs. You can also check the websites of investment banks that are active in underwriting IPOs. Sometimes the NASDAQ website lists upcoming IPOs, and you can look for ticker symbols that typically end in U that U often signifies a unit, which usually includes 1 share of common stock and a fraction of a warrant to buy more stock later.
Warrants add another layer of complexity.
They do. There are also specialized websites and industry associations like SPAC Research that track SPAC filings, like the initial S-1 registration statement filed with the SEC, and provide data on existing and upcoming SPACs.
So what's the financial bottom line on SPACs? Are they for every investor? Clearly not, right?
Definitely not for everyone. SPACs are inherently speculative, high-risk investments.
Yeah.
They often merge with growth companies, startups, sometimes pre-revenue firms in emerging industries. They are emphatically not a widows and orphans investment. That old saying meaning they're absolutely not suitable for conservative investors who can't afford potential losses.
But for some people.
But for smaller, more risk-tolerant investors who understand the dynamics, they can offer a unique, albeit risky, way to get exposure to companies earlier in their life cycle. Sort of like getting into the IPO game, which is usually hard for individuals. Some analysts try to find the best SPACs by looking for experienced sponsors, attractive target sectors, or using metrics like low volatility or strong buy ratings post-announcement. Apex Technology Acquisition Corporation, APXT, which focused on software and internet tech, was mentioned as one potential example in some of our source material, but specific recommendations are always tricky and time-sensitive.
Got it. High risk, high potential reward. Do your homework and know what you're getting into.
That sums it up perfectly.
Wow. We have truly taken a deep dive today, haven't we? I mean, from identifying those sneaky, often hidden financial pitfalls that can really drain our resources, to understanding the powerful foundational strategies for actually putting our money to work effectively.
Yeah.
And then even peering into the complex, sometimes counterintuitive world of value investing and the pretty speculative landscape of SPACs.
Indeed. It's a lot to cover. The world of personal finance and investing, it can seem overwhelmingly complex, maybe even intimidating at first. But hopefully, with some clarity on the common mistakes to avoid and a solid understanding of how to strategically approach investment, you feel more empowered to make informed, impactful decisions for your own financial future.
Absolutely. So here's a final thought to leave you with. If the market, as Benjamin Graham suggested, is often like that insane salesman, how can you leverage that very irrationality, not just in stocks, but maybe in other areas of your own financial life, to find opportunities that others might be missing? Something to think about.